All right, welcome. If you are not familiar, my name is Chris Achinelli. I build, buy, and sell simple, profitable businesses every single day. Startup Exchange is one of those businesses. It's a community and platform to help other folks build, buy, and sell startups. And what I wanted to do is actually talk through a deal structure that we have. I do this with my firm, Blue Collar Capital. We're kind of like a micro private equity firm. I call us like the common man's Berkshire Hathaway, or like a poor man's private equity. What we do is we try to do simple deals that make sense for everybody involved. And we target them for ideally mostly bootstrapping entrepreneurs. We call them investopreneurs. It's the type of folks that we like to do deals with. And it's also like folks that we love to join our community and be a part of our overall network. It's concept of taking an investor's mindset and an entrepreneur's passion, putting them together, leveraging the best of both worlds in order to take a risk mitigated approach to entrepreneurship. So what I want to do is actually go through and walk through our offer of a deal. This is something that, again, we do. This is our structure. This is how we do deals. We do deals every single day. And if we're working through this and you actually are looking at it and you're an entrepreneur and an investopreneur and you're like, maybe I want to do that deal structure, or that sounds pretty good and I'd be interested in that, then please reach out. We want to talk and we want to do a deal, right? We're on a mission of doing 100 deals a year, every year for the next 10 years. That's kind of like the self-challenge that we've given ourselves. So if you are interested for the right reasons, then please do reach out and let's do a deal together, right? In the meantime, what I want to be able to do is share my screen and walk you through the deal structure that we use and how we actually go out and buy businesses and do deals, and how we do it in a risk mitigated way, how we take risk off the table, not just for ourselves as the buyers looking at businesses, but also for the sellers, for the folks that we're partnering with into these deals. We truly believe you get more by giving than by taking. We have this concept that we talk about, being selfish to be selfless to be selfishist, right? Selfish, you look your own best interests, but if you oftentimes do that and do that alone, then nobody's going to win in the deal. Selfless being look at the other side of the table, right? So if you can take a moment to appreciate the folks that you're working with, see things from their perspective and understand what their needs and requirements are, then you can get aligned into that. And if you can get aligned into that, then you can live in that selfish state. And that's going to be ultimately the best possible deal that you can make. And ideally, it's going to be a win-win-win, right? So what I want to do is actually share my screen now and walk through literally what our offer is, so that you can see it. And if you're listening, and again, if you have a startup business or a virtual business that you are maybe considering selling, and this sounds appealing to you, reach out. We want to definitely do these deals. And if you're a buyer and you're listening to this and you're like, that's a pretty creative deal structure, feel free to use it, of course. And if you want to use it with a little bit of support, reach out to us, because we're always looking for more folks to do deals with, maybe on a co-investment or whatever the case may be. So net, that's why we're sharing this. We want to be able to share, our perspective in terms of an approach. I think that it's awesome. And it's also a great way to potentially build and grow and foster the ecosystem as well. I think you get more by giving than by taking as well. So we call this our super simple offer, or a super simple deal structure. But that's what it is. It's a super simple offer. We try to keep things simple. Truly believe that if you can keep things simple, then simple works. Simple is not always easy, right? Simple is actually pretty hard, but simple oftentimes works best. And that's what we have learned, over our time, building businesses, buying businesses, and selling businesses. I do want to take a second and pause. I know that it's probably a little bit, maybe unconventional, but I think there's probably going to be folks watching this that aren't familiar with myself. If you're already in the community, you can definitely fast forward. If you watch the YouTubes or follow along with the podcast or anything like that, definitely fast forward. But if you're new and this is the first time that we're meeting, I do want to kind of build a little bit of credibility for myself and show you I'm not just some guy that's talking at you over the internet right now. I've been doing this for a pretty long time, right? So here's an article of me in the Tampa Bay Times back in 2009, when I was in college. The picture's no longer there, which I'm grateful for, because it was not a very flattering picture. It was me in my dorm room with a ton of laundry around me, a very messy desk. They did a good job kind of capturing it in the article itself, talking about the ramen noodles and stuff. But I built my first real startup when I was in college. It was a social network for investors, actually the first ever social network for young investors. And it was really cool. I didn't know what I was doing. I happened to find myself, in this thing. I was an investor and I had a strategy that was working. And in order to make it work better, I ended up building this product, which was this social network. And that ended up scaling. More folks got involved. Long story short, this was the first time that I realized that, deals are a real thing. And at this point in my career, I didn't really have the infrastructure. I didn't have the support network, and I didn't know what I was doing. So I actually got taken advantage of, in this company. Actually, my first 3 startups, I kind of got taken advantage of in the deals on the backside, on the exit side, as an investpreneur, building and then going and selling. So I felt this, and I felt this firsthand. I then went on and I built another business that was kind of like more of a tangible lifestyle. It was a card, realistically. And I built it. It was good cash flow. And, to be perfectly honest, I didn't think it was worth anything, right? Like, it was actually like a good, like, physical lifestyle, simple business, making money. And instead of going and selling it, because again, I didn't think I could sell this thing, I didn't think anybody would want to buy it. I just walked away from it. So that was, also money left on the table. And then my next startup, I ended up scaling, actually, and it was I scaled it pretty successfully to an 8-figure business. And in the deal structure there, I left quite a bit of money on the table. So my first 3 deals, because of experience, lack of experience, etc., I left quite a bit of money on the table. This one is actually an article in 2011 when I moved back home and I launched an accelerator. So this is after I had a decent exit with one of my earlier startups, and we started to teach or accelerate and invest in other companies in my hometown. And I started to, learn this process of kind of investing in and accelerating from the other side of the table. We weren't buying businesses yet, but, we were actually, doing like early stage investments into it. Turns out not a great model. And it was actually from the pain of this. And then I, went on and I didn't learn my lesson the first time. I went on and launched another accelerator in 2016. I partnered with IBM, and it was an AI, artificial intelligence accelerator, actually, to help build AI companies. But I didn't learn from those 2 experiences that the early stage investment game is not a very, it can be hard at times, but it was from the pain of those 2 experiences and working with a ton of awesome companies, both investing and accelerating them, as well as stepping in and, building a little, a couple more companies, and then also stepping in as more of like an executive advisor to some companies that are growth stage organizations, 8 figures trending towards 9 and 10. That kind of realized like there's some basic fundamental principles that go into building a company successfully, getting it to this point of profitability and sustainability, and ultimately turning it into a good asset, right? And it was from all of those combined experiences, the good and the bad, mostly probably the bad, probably more pain than anything else, that realized that there's a model behind buying companies. And if you can buy good, right? If you can buy right, then the likelihood of you being successful is pretty high, right? A lot of the money is made in the buy, just like real estate, right? I think that's a common theme, or a thing that they say about real estate, is if you could buy right, the money is in the buy. It's the same with businesses, and it's all about taking risk off the table, right? So if you can de-lever risk into deals, if you can figure out how to approach a deal and an opportunity to remove as much risk as possible prior to committing to that deal, then the likelihood of that deal being successful is higher, right? It's kind of actually pretty common sense. Again, simple works best, but simple is not always easy. And in order to do that, a lot of traditional investors and firms and funds and all this stuff, they'll do like really deep diligence. They'll hammer it home early, because that's what you're trying to do. That's why you do due diligence. You're trying to take risk off the table before you take on the liability of the asset, right? Now, in our deal structure, I built this, having been on the other side of the table, having been an entrepreneur, or what I like to call now an investopreneur, many times over, for years and years and years and years. And I kind of designed it as like going back, what would I have wished somebody offered me as a structure? Or while I was in some of these stages, right? Like with the accelerator, we invested in a ton of companies that we just shut the doors with. And it's like, there's so much money left on the table with a lot of these deals. If more folks were in this buy side in that space, like what's happening now, it would have been awesome. So I take that perspective. And I think that that's a big part of the deal making and a big part of the approach in terms of our perspective, right? Change your perspective, you can change your approach. You can't control everything, but the thing you can always control is your actions. And oftentimes your actions are what your approach is, and your approach is often shaped by your perspective. So change your perspective and change your approach, and you can also oftentimes change your outcomes, right? So we very much so took that in terms of how we designed our deal structure. It was literally thinking about it from both sides of the table, right? Again, what makes sense for the seller? How would a good deal look for a seller? What's aligned there? And then on the buyer, right? On the buy side. And by thinking about both perspectives, it's all about optimizing the deal to make it as least risky as possible for everybody involved. And if you can take the risk off the table for everybody, then all you're left with is the upside, was the reward, right? And it makes it a win. It makes it a win most of the times, if not all of the times, right? There's no such thing as 100%, but it's pretty, it's pretty high up there in terms of percentages. So that's what we did here. That's how we approached it. It's literally, thinking about the seller and thinking about what I'm looking for as a seller. When I'm a seller in a deal, right? So when I'm an entrepreneur building a business, I have two things that I'm really thinking about that I tie to risk in my decision making. One is opportunity cost of the long term, right? Meaning FOMO, like what happens if I sell now and then this thing hits it and I sold too soon, or I sold at bad terms and I'm missing out on all this upside. That's like a real thing. That's a potential real risk. I sell wrong, right? And another risk that's really true risk, that's real exposure, is while you have possession of the asset and building the business, right? While I'm building the business, I'm exposed to real liability and risk. And it's like, what happens if in 3 months things don't work out and I have to shut the doors, or I run out of money, or right? So you have this real risk that you're holding, and then you have this potential risk of missing out, FOMO and opportunities on the upside. And if you could structure something that kind of addresses both of those risks, then that's a really appealing offer for a seller, right? Like, let's take the risk of being an entrepreneur off the table, and then let's partner up and figure out how we can align into this like mutually beneficial upside. Now, on a buyer, I think I already mentioned, you're trying to reduce risk in terms of taking on a bad asset, right? You don't want to take on liability, right? So you want to make sure that what you're doing is buying right. And the way you do that is to, understand the diligence and then get good terms, right? So by taking that approach, what we ended up designing is this super simple offer, which turns into an option to buy. So when we get into deals, what we're really looking to do is get into an option agreement, which is really just like the option, truly like an option to purchase. And we want to get an option to purchase that company at any point in time within a 12-month period. Right. So we put timelines on it. So this isn't like an indefinite thing into perpetuity. It's like within 12 months, we know set start, set finish. That's the framework that we're looking in, and that's what we're partnering with. But we will make an acquisition. We have the option to buy you in that period of time for a very specific set price. And that's what the strike price is. So the way that we set that up typically, and this is more often than not, and nothing's ever set in stone in deal making, right? There's always a deal to be made. That's the other thing that we say, is like, there's always truly a deal to be made as long as you're rational and pragmatic about it. But typically the way in which we formula to approach this deal structure is taking the current month profit and annualizing it. So what that means is take your current most recent month, multiply it by 12, which then brings it out to a year, annualizing it, and then multiply that by 10. And giving you a 10x value on your profit, annualized profit, which is pretty fair, especially for like smaller deals, right? Typically, the smaller the deal, the more risk there is. Smaller the deal, the more risk. typically the lower the lower the multiple, right? So that's actually a pretty high multiple, which is what we tend to do in terms of this deal structure. We tend to try to overvalue, deals in terms of the market, in terms of valuation, because we want to make it super appealing to be able to get in to the opportunity to partner, right? And we want to partner into this deal for the next 12 months and make sure, it becomes a win-win-win. And that's what we're trying to approach here. Again, be selfish to be selfless, to be selfishist, and create the biggest possible win for everybody, right? So once we get into these terms and we set the terms, what it really means is that we will buy, our business will come and buy you for this amount of money at some point in time within the next 12 months. And if you're okay with that, let's move forward, right? If you consider that's a win and you think that that is a deal in which you would want to do, let's do that deal. Let's continue the conversation. And the reason why we structure it like that first, before we go deeper into why we're doing this and the partnership behind it and the synergies and how much growth can come from this, is we want to kind of kill deals on the vine fast, right? We want to find folks that are kind of inclined to take this type of offer because they have enough experience to know that this is a good offer, right? We don't really want folks that maybe are early, or new to their journey and haven't had enough pain or experience to, they still have the rose-colored glasses on. We want realists, right? We want to really deal with real entrepreneurs that are doing this and doing it for the right reasons, that we can partner with and be successful with the long term. So if somebody sees an offer like this and they're just like, I'm not really interested in this offer, we know that that's not a great person for us to continue the conversation with right now, which is perfectly okay. And it allows us to focus, right? The whole point of killing deals early on the vine is it allows you to focus on the quality deals, the relationships that, likely will succeed and have the highest probability of a good positive ROI. So you want to do this. You want to create conflict. You want to be able to put things up front and let folks kind of decide and navigate the decision point. If somebody sees this and they're like, wow, that's a pretty good offer, I'd be happy with that. That's something I could commit to. Then you kind of move forward. And in moving forward, it's why, what are we doing over that period of 12 months, right? Like, what's the whole point? Why don't you just buy us right now? And the whole point of not buying it right now is because, again, on the buy side, we're trying to take risk off the table and we're trying to understand the business. We're trying to do our due diligence, right? And we don't want to just have to scramble and due diligence fast. We want to actually know the business. We want to have the opportunity to be in the business. We want to have the opportunity to improve the business, right? Same in the short term for the seller. Short term of the seller is like, let's make this business as successful as possible, as quickly as possible, to make as much money as possible in the now, right? The better we can make the business now, the more profit I'm putting in my pocket now, and also the higher the valuation of the company or the better the asset is if this deal doesn't work out, right? So for both parties, it makes a ton of sense to kind of focus on optimization of the company or the optimization of the business, the asset, in the now, in the short term, in that 12-month period. So that's what we do, is we'll come together and we'll actually partner over that period of time to work together to grow the revenue, improve the process, and optimize profit, right? So it's all about growing really profitability at the end of the day. In order to do that, what we end up doing is focusing on two things, right? And now this is our team literally coming in, and we would take almost possession of the asset. We'd be working, with the founder, with the investopreneur, to actually go and do this by focusing on acquiring customers and improving process. We know from all of our experience, right? Acquiring customers is like it's like the magic money machine. If you know how to acquire customers the right way, you're able to always feed a funnel and generate revenue, which is awesome. So we'll put things in place in order in terms of acquisition of customers, and we'll invest our own resources and our own support mechanisms to be able to do so and support so successfully. And then you have this thing called process improvement, which process improvement is really just another name for due diligence, because when we're looking and working through due diligence, right, getting a company acquisition ready is what we call it realistically. You're kind of looking through the weeds of that company. And while you're looking through the weeds of that company, you have the opportunity to kind of, identify areas to improve that company. And the whole point of improving the company is to, streamline it, right? make it make it run more efficiently and effectively, optimize, like reduce expenses if you can, and ultimately drive better profitability of the business, off of it operating and servicing the customers that you've been able to acquire. So that's where we'll focus. Now, by doing it, you're also increasing the value of the company, because realistically on the buy side, what we're trying to do is buy companies that just kind of work, right? Obviously you want a company that makes money, but it's better to have a company that makes money that's, not a lot of work. So you really do want a streamlined process, and the better process that's in place, the more valuable that the asset really kind of is, right? I'd think about it. I'd much rather have something that's paying me that I don't have to put my time into than something that's paying me that I do have to put my time into. If I have to put my time into it, it's worth less, right? Because you got to pay me for my time, right? So think about it that way. You know what I'm saying? That's a pretty practical perspective to take when you're thinking about building the asset. Now, on the sell side, it's the same thing, right? Like you want to have these things in place too, but oftentimes as an investpreneur, an entrepreneur building a business, it's kind of difficult to, like, you're driving down you're in the train and you're also laying the track in a sense, right? So you're doing everything, and it's really difficult to do things like put process in place and optimize the business and do things while you're also building a business. So more often than not, we find that these things just haven't been done yet, which is perfectly okay. And it's a great opportunity to come in a very simple way, get it done and make a better business because of it, more profitable, and save people time, effort, energy, stress, all that stuff. Now, while we're doing this, because the alignment is so tight, right? In the short term, there's alignment for the business owner to put more money in their pocket by doing these things, making a better business, more profitable, more money in pocket, while I own the asset. And you still own the asset for that 12-month period of time. We haven't bought it yet. For the buyer, you're making a more profitable business for the long term. So you want to do these things because it's going to, once you take possession, it makes it more valuable. It makes it a better asset. So there's both the short and the long-term incentives that are aligned incentives for both the buyer and the seller in this agreement to do these things. Now, there's also what we find is there's better alignment and more synergy when there's an equal upside, when there's a share in the upside of what's getting done. Right? When both the buyer is rewarded with an incentive of profit share, as well as the seller is rewarded an incentive with a profit share. Profit motive is a powerful thing. And if you can align that profit motive, then the likelihood of things getting executed and completed, right, successfully is higher, and the deal is more likely to succeed. So what we do, the way that we approach it, is we'll look at the current, again, that current monthly profit, and we'll typically add on a multiple, right? So we'll typically put on a premium to make it super fair, because really the goal for us while we're doing this is, again, due diligence, and you're trying to make a better asset so you can reduce, risk and liability prior to taking it over. And there's a lot of reward that's intrinsically inside of that. So it's not really, you're not in this deal necessarily to share in this profit upside. It just makes it a little bit better and more incentive and more aligned when you do. So we really try to make this in the favor of the seller, right? So that they can be aligned to grow and improve for the right reasons, this business, and in the process, put money into their pocket, more profit into their pocket. So typically what we'll do is we'll baseline it, and we'll put a little bit of a premium, so whatever the current monthly is, add maybe another 10, 20, 30% onto that. And then everything over that baseline, we end up splitting the profit of 50-50, right? And again, keep in mind, it's the buy side, it's us that are putting in time, effort, energy, resources to be able to, again, acquire more customers and improve the process, right? So it becomes actually a pretty fair and extremely fair and potentially lucrative type of arrangement for that 12-month diligence period, right? The 12 months in which the company is under contract or option to buy. While we're looking to optimize process, what we're really just doing is focusing on getting an acquisition ready. And again, that's through a very structured type of approach. So with us, when we're doing this, we know that once we get somebody into option, we're putting them through a pretty regimented type of process that just works, right? Process works, right? When you systematize things, systems work, systems work for a reason. Everything is pretty much built off of a system. It's just because you put in inputs and you get outputs, right? It's predictable, reliable. It takes a lot of human error out of things. It's just a good way to approach stuff. So what we've done is we've systematized or productized our approach into this program. And we call it our acquisition accelerator. And what it really is just getting companies acquisition ready. It's, we want them to be ready for us to be able to acquire them at the net of it, right? And what we're doing is we're organizing a company, which organization is really just like kind of a framework of diligence, completing and getting ready to complete the successful due diligence, standardizing it. So once we've gotten everything organized, we can now kind of standardize in terms of inputs to outputs of, what needs to happen to get what we need or what we want, right? And when you think about a business, you can really think about it as almost like a machine or a business system, right? And it's inputs to outputs. It's, how do you get to the throughput, or like how are you generating revenue? What constraints do you have on the throughput? Like what's in the way of the revenue? How do you remove those constraints? And how do you just support a business system that just flows through simply, right? And systematization is a great way to, ultimately optimize the company for profit. So we'll go get organized, we'll standardize, we'll systematize, and then we'll optimize. And the whole point of this is to optimize around profitability, because we're trying to build a better asset. And that's the approach, right? To be able to optimize for profit. Now, what we found in doing this is that there has to be some level of mutual skin in the game. We have a process that kind of already works. We're putting a lot of time, effort, and energy into it. If you take this and make this offer to pretty much any business owner, and you're saying, hey, let's build a better business and make it more profitable in the short term, and we're going to do all the work, I don't think there's anybody out there in business that would say no to that. That's kind of like a no-brainer. It's like, all right, yeah, I want more money. Sure. What we find is that in order to get somebody or be willing to have somebody, allow somebody to pretty much say yes to be able to do this through partnership, it needs to be a two-way street, and there needs to be some skin in the game. And what we've always found is that the fastest way to get skin in the game, the cheapest way to get skin in the game, is money, right? It's just pay somebody to do it, like an exchange of capital. And what that really is an exchange of confidence. So what we ask is that folks that want to do this exchange, whether it's 2,500, 5,000 or more, depending upon the size of the business, et cetera, we ask, the company's paying an accelerator fee, to actually get into the option agreement, to get into the accelerator program, to be able to optimize the business. Now, you may say, well, what happens if you don't do the deal? Or what happens, in the period of time? Like, what happens if things go south? It doesn't really make sense. It doesn't really feel fair now. Like this, up until this point, this was so awesome. It was so aligned for the entrepreneur. Everything you guys are doing in terms of, being this micro private equity firm, buying businesses, it's so entrepreneur friendly. It all tracks in terms of an investopreneur, for investopreneurs, by investopreneurs. Like it feels good, but now you're charging this fee up front. It doesn't really feel good anymore. So the way that we approach that, because we understand that concern, and again, we always take both sides, perspective of both sides. So hopefully you can see our side and the perspective from our side in terms of, again, qualifying and focusing on the right relationships, because the person who's willing to do that is probably the right deal to be done. Right. But we understand it. So we want to justify and understand and communicate our understanding in our approach here. We've designed this to truly limit risk. Can't remove risk from every deal, but we've tried to limit risk as much as humanly possible in this structure to truly make it a win-win and win. And a win-win and win is like in any scenario in which this plays out, everybody's comfortable and knows up front what it's going to be. And we're all cool with that. Right. So that's how we really approach this. So the first win is the original agreement, literally option to buy at this price. So, 12 months comes, anytime in that 12 months, we decided, hey, we want to take on this company. We want to buy this company. We just do the deal. We give you the agreed upon money and the deal gets done. And we actually buy the company and the option is executed. Simple, easy. We've already done the diligence, and that's why we do this structure. We know where the business is at. We're very confident that this is something that we want to do at this point in time, because we've been able to work together and partner through this journey. And it's just super simple. So that way the closing would be quick. It's just like a very clean, simple deal for both the seller and us, right? We can make the seller's life really easy in the structure. Now, what happens if that's cool, right? That's like why we're all here. And that's what we're kind of agreeing to in the first place. Now, what happens if we don't buy the business? all right, what happens like now you guys, we didn't end up, you're not buying the business, but we gave you this money for the accelerator program and all this stuff. Well, in that situation, it's a win for you because it's a win for both of us. It's still a win-win. Again, all these are win-wins. Like the first one's a win-win because it's what we agreed to up front. It's what we wanted to do. If we break out of that, right, and we don't execute the option, it's a win for you. It's still it's a win for us because we're choosing not to do that for a certain reason, right? Maybe it's risk or liability or a business that we don't want to get into, something happen where we just don't want to do that. So our ability to walk away is a win. For you, it's a win because we will give you back, right? So we'll give you back whatever that initial accelerator fee was. So there's not going to be like a financial exchange there in terms of a cost to you. And you'll also keep full ownership of this improved business, right? So again, over that period of time, in that 12 months of the option, we're putting in a lot of time, effort, energy. We're working our process. We're putting our resources. You get full access to our team and our platform. We're acquiring customers, improving your customer acquisition model. We're optimizing the business system itself. We're making the business more profitable. And we're doing that pretty much, at no fee, realistically. And if we were to charge, like a market rate with our team doing that, with our skills, abilities, traits, et cetera, it would probably be extremely high, right? Like it would probably be like hundreds of thousands of dollars in order to pay us to do that. So you would get all of that improvement and you would get your money back and everybody would just walk away. So it's a huge win for you. And it's a win for us because the risk isn't there. We decided it's a freedom to decide. And that's the cost of of having the freedom to decide is, the cost is the time, the opportunity cost of our time, effort, energy, and everything. And we get that. It's a deal, right? Now, what happens if, this is a killer deal? We accelerate, we blow open customer acquisition, we streamline business process, and there's just so much profit in this business that now the original agreed upon option price doesn't really make sense. Right? That initial 10X that we agreed to, which was like a great offer then, is no longer like a great, great, great offer. And you as a seller are like, I don't want to sell. Like I'm making so much money with this business now. It's so awesome. Like, I don't want to sell this thing. What do we do then, Chris? Like, how does that work? Is it going to be a lawsuit? Is it going to be this big issue or whatever the case may be? In that situation, we built into the agreement the clause that if you don't decide to sell, that's okay too. We'll take the conversion value of whatever the difference is of the option to buy, which was again 10X of whatever that multiple was, or of whatever the profit model is. We'll do the same exact valuation model, right, to what the business is now. We'll say that this is now what the business is worth. And whatever that wedge is in the middle, the difference in the middle, we'll convert that value into equity in the business and we'll become your partner. And at that point in time, now we're partners for the long term. You don't have to sell it. We still have we are able to still execute and capture it to value. And now we're true long-term partners continuing to build this business, which we've clearly been very successful in doing together for the last 12 months or whatever the case was, because this is the situation that we're in. So again, a massive win there. So in any one of these three scenarios, we buy it, it's a win because that's what we already agreed to and we were already happy with, and we knew that going in. We don't buy it, it's still a win. And you don't sell it, it's still a win. So no matter what, it's a win-win-win, and we're all always happy in this. And that's why it's a limited risk, win-win-win type of structure. And that's also what makes it super simple, because it's aligned, because no matter what scenario ends up coming out, everyone's kind of happy with it already. And we know what these scenarios are up front, and we're making an upfront decision. There's no confusions. It's simple. And because it's a super simple deal structure, that's why we like it so much. That's what makes it built for investpreneurs by investpreneurs, right? This is like, again, investpreneurship, a less risky approach to being an entrepreneur. We built this entire structure having been our investpreneurs our entire life, and kind of, backing into what we wish a deal structure other folks would have offered us, right? It's just a collaborative thing. You're getting to leverage the resources of a partner that, you're not paying for that, right? Like, think about the amount of money that you'd be paying on a consulting or advisory, the resource of the infrastructure, if you were to buy the platform that we have in terms of like our ability to actually do this. like the amount of investment that goes into it. So you're literally leveraging all of that, and it's a pure upside, across the board. So it's just like such an aligned deal structure. We know what it is too. So like, if it goes south and it's a great deal and, you don't want to sell it, which, we get, again, we're all up front. Like we know what could happen in any of these scenarios. And because we're doing this and we're doing this together as partners, we're totally okay with it. And that's why it's truly built for investpreneurs by investpreneurs. And it's just a safer way for anybody who's like not building, part of that 1%er club of, a venture-backed company raising hundreds of millions of dollars. Like this is just a great deal structure, for you realistically to be able to go that route. So that being said, how does this compare to more traditional capital partners or traditional buyout firms or whatever the case may be of what you would otherwise be looking at in the market? Now, I think that this is probably pretty important. I mean, obviously, this is built and designed to, skew it in the way of like making us look good and them look bad. I mean, if you look at these columns, it's us yeses and them the nos. But that being said, it's also kind of the case. So even though that's the way it is, that's the way it is because that's kind of the case, right? Like with us, you have these upfront terms. Like we're literally laying out the terms of the deals up front. You know what's going to happen in terms of the option agreement. You know what the rev share is. You know exactly how we're going to approach it. You know what happens if it works out. What if it doesn't work out and you don't buy it? What happens if we don't want to sell it? Like it's all very clear and it's all up front and it's all 100% aligned. Whereas traditional firms, I mean, again, you always got to understand the deal is made, it's all about reducing risk, right? So traditional firms, if they have to scramble to get diligence done fast and they don't really know what they're buying, right? That's why this deal works for us so well. And we want to just do it. It's like a very uplifting strategy for us is because what we're really doing is we're being afforded, 12 months to make sure this is the right type of asset that you want to take on as a liability, right? To reduce that risk. Traditional firms doesn't have that, they're scrambling to figure out and they have to reduce risk somehow. So if they don't feel confident in the diligence up front, they're going to try to beat you up on terms or they're going to try to change the terms at the closing table. So that's why things go south and things get hairy and they say that there's always a hair on the deal and stuff like that. We avoid that. It's super fair. It's super upfront. It is what it is. Just it is what it is. Simple. We're also a partnership. And it's not just a partnership saying, oh, we're partnered and oh, we're partners and oh, like how everyone else says partners. Like this is a partnership. Like we're actually sharing in the short term. We're splitting 50-50 of the upside, doing and growing this business together successfully and in a very fair way. Again, we're using a very fair baseline, right? Because, if we weren't in the equation, you'd be in that baseline and that would be your money anyway. We're not touching what would have otherwise been your money. We're only sharing in the improvements that we're making above that baseline. And it's 50-50. So that's true partnership. And then if it doesn't, if you don't sell it, we're like literally actually partners, like we're converting into a long-term relationship because if you're not selling it, that means that we did such a great job in that 12-month period that it's just such a killer company. You shouldn't want to sell it. But we definitely want to partner with it and for the right reasons, because we did a great job with you, building it successfully for the long term. If you do sell it to us, we believe in a very virtuous type of life cycle. So hopefully you go out and do another business and we do the same thing again, right? We believe in, again, investpreneur life cycle, build and then buy and then sell and then build, buy and sell and repeat it again, right? So it's a true partnership. Access to resources. I mean, traditional firms, they're a black box. Like they're not helping you or giving you anything until they acquire the deal and then it's theirs and it's not yours. And so they're not ever giving you resources, right? Like they want to beat you up as much as possible, get as best of a deal as possible. Realistically, we are literally giving you our platform to build and incubate and accelerate this deal while we partner in the deal structure and the deal process until the point in time in which we execute the deal, right? So you're literally getting access to all of our resources, our processes, our IP, our capital, right? And in that process, because you're working, through it with us together, you're also getting experience in the growth from the process, right? So when you're working with traditional firms, again, it's like us versus them throughout this whole process. Whereas with us, we're partnering together and we're just doing stuff, right? We're executing on making the business better, which is why we should be here in the first place. And you're personally getting experience and growth. So like you're going to be experiencing how we do this stuff. So you'll literally see it. And you're also going to get the growth from the business. Like the business is also getting, experience and growth. So it's kind of like a huge win-win there. The next thing is this option to say no, which is like, all right, now we grew this business again. Traditional firm is not going to let you back out of an agreement, right? There's going to be different types of, they're going to do different things that will prevent you from being able to do that without it being painful for you, right? Like if it's a good deal for them, they want to do that deal. They won't want you to back out without it costing you something, right? With us, we build in the option for you to say no. If you change your mind, that's perfectly okay. And we know exactly how we're going to do it. And it's for the right reasons. And it's very aligned, right? So super fair. Very, very, like, again, that freedom, right? The freedom to decide is such a powerful thing. And I believe that that's what makes capitalism great. I think that's what, right? I think freedom to decide is one of the most powerful things in the world. And that's what we try to build into our deal structures as well. Because that's how, again, everybody wins in the long run. And then again, that rinse and repeat. I was talking about that earlier in terms of like this virtuous cycle. We want you to do more deals. We want this deal structure to work. We either want to partner for the long term, or we want it to be a successful short term. And then hopefully you build and rinse and repeat the cycle, or maybe you buy a deal from us, or whatever the case is, right? We want to do a very virtuous, repetitious type of rinse and repeat type of cycle. So that's like how we would compare with our structure versus other guys in a sense. And we've tried to really build it for the investpreneur. Now, if you want to do this, if everything that I went through is like very appealing and you're like, oh, I think that actually I would want to do this structure. It makes sense. I get it. I see it. I want to do this. This feels right. Then the first thing that we would want to do is align into a vision, right? The other guys, I mean, they're talking about terms, right? Because it's cold, it's a contract, and it's transactional. With us, it's a vision. We want to make sure that we're doing it for the right reasons. We want to see the fact that you want to get to that exit, and we want to understand the why behind it. We want to know like what we're trying to do here for the right reasons, right? Because ideally, again, this is a real partnership for us. So it's not transactional, it's not terms, it's not cold. And that's why we say vision instead of terms. But what we're really doing is, we're deciding what that option agreement is going to look like, what the price is going to be, what the baseline is going to be, right? What the terms of the agreement will be, and we'll just sign them, right? So we'll understand the vision, agree on that. We'll sign the options agreement. If it makes sense for everybody, it makes sense. Again, that's the way that this deal structure is designed. So it's just a pure win, right? We'll sign it. And then we'll we'll accelerate, right? And the way that we accelerate is we have a set program, right? We have a structure and a process that we have already systematized and that we know works. We'll take you and adopt you into that. It's run inside of Startup Exchange, right? And we'll literally work through that process of organizing, standardizing, systematizing, optimizing the business, getting an acquisition ready, and improving the profitability, right? While we're doing that over that 12-month period of time. And at some point, we get to step 4, which is a win. At some point, we're going to win, because there's no question of will we not win. Either we'll win in the fact that we end up buying and we'll execute the option, and you get a payday and you get an exit and we bought the business from you, or we don't end up doing that and you get a better business that's more profitable and a ton of value that intrinsically has gone in over that period of time, plus your accelerator fee back in a sense. And you also, potentially could say no. And if you said no, that's still a win, because then we'll partner for the upside, right? For the long term. And I think if we end up being long-term partners, only good things will come from that, right? Again, success begets success. It's a very virtuous cycle. So if you're interested in doing this and you want to actually execute on this deal, we do these deals. This is the type of deal that we would do all the time. You can just reach out to us. And, at very least, we'll have a conversation. There's no harm in a conversation. There's no risk in terms of initially, talking this through. And if it makes sense, we'll do it. If it doesn't make sense, that's okay too. right? So if you're looking at this and you want to, actually reach out, you can reach out to myself. You can go to startupexchange.com. You can get in contact that way as well. And also at the same time, in terms of timeline to go from step one to step two. Now, we used to do these pretty fast, right? But where we are right now is we're kind of, to a certain extent, I don't want to say, we're limiting to kind of try to create this fear of scarcity or whatever the case may be. We're trying to standardize more now that we have more of deal flow coming through and more conversations and everything. We want to manage expectations, and I don't want to overpromise and underdeliver, right? So like, I don't want to say, hey, if you're actively interested in doing this, reach out and we'll do this deal and we'll have conversations like tomorrow and we'll get this thing going in 2 weeks or whatever the case may be. It may be a quarter, right? It may take like up to 3 months, maybe 6 months before we can actually get something on the calendar, have a conversation. In the time being, though, you could build relationships. You can join the community and Startup Exchange, reach out, participate in relationships. And if you're listening to this and you are not interested in this deal, but you maybe know somebody who is, you can also become a scout with us too, right? So we have venture scouts in Startup Exchange. They're kind of like a venture scout is to startups, as a real estate agent is to homes, right? It's like folks that are kind of like in this ecosystem, building relationships, making connections and introductions, etc. So if you want to do that as well, you can come on and be a scout, and you can actually make introductions as well to folks in your network or outside of your network that may be interested in this deal, now that you understand how our structure works. So hopefully we get to talk to you soon, and hopefully this was a time well spent for you and you enjoyed it, and look forward to getting to know you a little bit better, hopefully soon.